As a new investor, you most likely began with stocks. However, now that you have a little more experience, you want to start branching out and broadening your portfolio. After all, a diverse portfolio is the best way to minimize risk and maximize profit as an investor. Spreading your assets provides protection against market fluctuations, which is becoming increasingly important in today's world. Investing in commodities can be a good way to diversify your investments beyond traditional securities. But as a new investor, you should first understand what commodities are. Before we begin, please do give this video a like and subscribe to our channel. Commodities are any uniform resources considered to be basic goods, ranging from grains that make up your breakfast to silver and copper, as well as crude oil that's refined into petroleum. Commodities are many things, but they all have one thing in common. They are physical in nature and traded on global markets. Commodity prices fluctuate dramatically due to changes in supply and demand. For example, when there's large harvest of a certain crop, the price usually falls, whereas when there's a drought, the price often rises due to fears that supply will be reduced. Commodities are typically classified into four broad categories: metals, energy, livestock, and meat. Each category has its own set of advantages and disadvantages, so your decision on where to invest in is largely determined by your long term objectives. Commodities can be a risky game if you don't know what you're doing, and it'll be far more profitable in the long run. There are several ways to invest in commodities, each with its own set of advantages and disadvantages. Here are 6 ways to get started in commodity trading. The first one is to invest directly in the commodity itself. There's no better way to get involved in commodity trading than to invest directly in one. One pro of investing by physically purchasing a commodity is that you don't have to go through a third party. You can simply look for a dealer to sell you a specific item, and then when you no longer want it, that dealer will frequently buy it back from you. However, you must consider delivery and storage logistics, and if you're purchasing something like gold, this transaction may be relatively more simple. You can easily find a coin dealer online who will sell you a bar or a coin that you can safely store and then sell later on. It becomes much more difficult though for things such as cattle, crude oil, or even bushels of corn. As a result, investing in most physical commodities is typically too time consuming for individual investors. Number two then might be better for you by investing in commodity exchange traded funds or ETFs. If you know how to invest in stocks and you have a limited amount of money to invest with, it's best to approach commodities through ETFs. Commodity trading funds are funds that allow you to trade commodities. They can be bought and sold in the same way that stocks and shares can be. Investors who want to buy commodity ETFs use an online or traditional broker, just like they do with stocks, with prices changing throughout the day. ETFs are a great option for those interested in fluctuating commodity prices because they can profit from price fluctuations without investing directly in futures contracts. Trading ETFs is also a great way to gain exposure to the commodities market while minimizing risk because you can keep your ETF shares for as long as you want and they don't expire after a set period of time. However, you should be aware of some of the fees associated with trading ETFs. Alternatively, you could ask your broker if they offer a demo ETF trading before investing. Third, invest in futures contracts. Futures contracts is another way to get into commodity trading. A futures contract is a legal agreement to buy or sell a specific commodity at a predetermined price at a future date. Beginning with futures contract requires extensive industry research and is typically not recommended for novice investors. The reason for this is that much futures investing is based on speculation. Investors can, however, work with a broker or choose contracts that include the option to buy futures contracts. Traders speculate on the movement of commodity prices. When you believe the price will rise, you buy futures. When you believe the price will fall, you sell futures. Before we move on to number 4, please consider liking and subscribing to this channel. Number 4 is investing in commodity stocks indirectly. You can do this by investing in companies that produce commodities. You could, for example, invest in mining stocks, oil stocks, or agricultural stocks. Investing in British Petroleum allows you to get into the oil business, while investing in Rio Tinto allows you to get into all kinds of metals. The risks associated with commodity stocks are typically focused on the companies themselves. Prices may be influenced negatively by the business operations or other company-related factors rather than the actual value of the commodities. This means that a commodity-producing company's stock will not always rise or fall in tandem with the commodity it produces. The fifth option is to invest in mutual and index funds. Mutual and index funds are a good entry point into commodities for new investors because they operate differently than other types of commodity investments. These funds have the same liquidity as stocks, but they don't trade on an exchange like mutual funds. You place your money in a fund alongside other investors. When you invest in mutual funds, you usually have the assistance of a professional fund manager. Just keep in mind that managed funds typically have higher fees. A managed account allows you to invest in multiple commodities and industries, allowing for immediate diversification. Index funds, on the other hand, follow the price of a specific commodity over the course of a trading day. And finally, on number 6 are commodity pools. Commodity pools are a way for a group of investors to pool their resources to purchase futures contracts and options. If you have no prior experience investing in commodities, it's best to hire a commodity pool operator or a CPO. These individuals pool money from multiple investors into a single fund, which is then invested in a commodity or a commodity basket. Your CPO will not only manage your fund, but will also keep records of who's investing, what they've invested in, and the pool's transactions. They may also base their investment decisions on the fluctuations of a specific market. They can use the pooled funds to make better investments, resulting in more opportunities for commodity trading. Alright, that just about wraps the 6 different ways you can invest in various commodities. While commodities are known to be risky investment propositions due to uncertainties that are difficult or, if not impossible, to predict, such as unusual weather patterns, epidemics, and natural and man made disasters, commodities are best suited to investors with a large chunk of capital to spare and at least some experience. If you're looking to invest in a commodity for the long term, it may be best to manage risk by incorporating commodities into a well balanced portfolio rather than putting all your eggs in one basket. For most people, commodity stocks, mutual funds, and ETFs are a better option. Let us know what you think about commodity investing in the comment section down below. Thank you so much for taking the time to watch the video. Don't forget to hit the like button and subscribe button before you leave. Cheers!